Turning to the major stories across financial markets, a recession in the US is no longer the consensus. In a Wall Street Journal survey, economists lowered their recession probability below 50% and say the Fed is finished raising interest rates. The probability of a US recession has been falling quite dramatically. You can see at its peak, October 2022, it was 63%. April 2023, it's been just coming down ever since. It's now sitting at 48%. GDP is expected to increase 2.2%, and that was from an average 1% in the last revision. Strong economic growth takes economies out of recession. Economists expect the Fed to start cutting rates in the second quarter of next year. Economists also expect that yields will ease in the coming months, with the 10-year closing out at 4.47% at the end of the year, and a fall of 4.16% by June 30th of next year. US consumers are buying less from China, dropping its share of imports to a 20-year low. Around March of 2018, 21.8% of US goods were imported from China. That has currently dropped to 14.9%. The US is importing more goods from the EU and the UK, as well as Mexico and Canada, and the rest of Asia excluding China. In 1987, only 1.5% of total trade with the US was done with China. That reached 16.3% in 2017. It's now fallen off a cliff to 10.9%. Back in 1987, Japan did 17.1% of trade with the US. It's currently 4.3%. Mexico is definitely the quiet achiever, rising up from 5.3% in 1987 to 15.7% in 2023. The US still imports 75.7% of its smartphones from China. When the war over semiconductors was breaking out, China had around 6.7% of the semiconductor imports into the US. It's since fallen down to 5.1%. You'll notice that India's uptake from 0.1% up to 2% is very significant, and Taiwan's percentage has remained fairly level at around 14.4%. However, Vietnam has spurred up as well as Thailand. China had 40.7% of apparel imports in 2017. That's fallen down to a little under 26%. Apparel is being imported from other countries in Asia except for China. The percentage of US furniture imports from China January 2017 was 44.6%, and you can see how it's fallen down to 25.7%. Still a pretty healthy chunk, but a big reduction. Mexico is incoming. Mexico is raising its percentage. So this is something as an investor or a trader that you might like to look into. Mexico, Vietnam, and Thailand, as well as India, are showing signs of economic growth from the world's largest economy. The Fed has suggested that the natural rate of unemployment to achieve a 2% inflation target is 4%. Philadelphia's Fred Harker says that 4.5% unemployment in 2024 is possible. But mass layoffs are not expected. The US profit recession for companies is coming to an end. They expect in Q3 of 2023 a 1.2% decline in corporate earnings, followed by Q4 a 6.5% expansion, even more 8.1% in Q1 2024, even more that in Q2 2024 11.7%. Things are starting to get rosier. This is extremely good news for stocks, global indices, commodities, and crypto. These statistics help us to understand the bottom is already in. There will be a range of profit upgrades in the making, and stocks have the potential to catch up to those profit upgrades. To come in for a soft landing, the US needs to keep the CPI and the PPI down. Recent positive shocks to the CPI and PPI drove yields up. As an investor or a trader, And we know all investors become traders anytime they buy or sell. Keeping your eye on the war inside the Middle East is really important. If it spreads, it could pull other countries into it, just like what we saw with Russia and Ukraine. 3 scenarios that you want to keep your eye on as far as financial analysis: a confined war, a proxy war, and a direct war. A proxy war would spill over to Lebanon and Syria and be a proxy war between Israel and Iran. A direct war would involve military exchanges between Israel and Iran. In terms of global growth and global GDP as well as inflation, a direct war would be seen as lowering global GDP by 1 point, and inflation would increase 1.2. This is based on an analysis of past wars. Warfare in any form is really bad. It's so destructive, and the loss of human life is just terrible on both sides. As a trader and investor, you must be aware of how war impacts economic systems. For example, if Syria and Iran get brought into the war, we would expect spikes in the US 2-year, the US 10-year, and the DXY. Gold would also be appreciating in value under these circumstances. If the war is contained, we would expect that the yields and the DXY would start to fall, and there would be broad-based rallies across the stocks, major indices, crypto, and commodities. Supply and demand shocks to oil are also important to track. When Russia invaded Ukraine, there was an enormous spike in the price of oil. Increases in the oil price drive inflation up, and we saw massive inflation when Russia invaded Ukraine across the entirety of Europe and also the US and other countries. But Europe was hit particularly hard. The other factor to consider: as oil prices increase, gas prices increase, petrol prices increase as well. When things become too expensive overall, people just change their habits and they won't drive their cars. All global markets are interconnected. As a global family, we dig behind the news headlines to find out what's actually occurring inside the markets. The probability of a 25 basis point increase at the next FOMC meeting is currently 10.6%. 1 day ago, it was 6.2%. Inside financial markets, you don't need certainty, you just need a strategy to profit from uncertainty. Your best strategy is always knowledge and an understanding of the rules of financial markets. Rule 446, all markets are intercorrelated and interdependent. This means that all the charts are intercorrelated and interdependent too. Your strategy should revolve around market structural levels. Inside the Tier 1, especially the Tier 1 because they're the engine of financial markets globally, also the Tier 2s and Tier 3s to stack probabilities. When we look at US oil, and that's marked up since 1861 with the CTKS method, but before we go into that, you might notice that oil came up to a specific level and it's just starting to struggle. Why would it start to struggle? Because there's so much structural resistance up here for oil from that 88.04 level upwards, 88.07 and 88.21. When you have a lot of structural resistance overhead, it's very hard for the price to get through that. It either has to consolidate to try to figure out if it can actually muster enough support to attack it and go through it. If it doesn't, it's going down to the next structural support level, which is 85.91. The strategy to profit from uncertainty is to know these structural levels. If you're investing in tech stocks, following the NASDAQ is really important. Your strategy to deal with uncertainty is to know the structural buy and sell levels. That would need to be marked up from 1973. Let's pop on the indicator. What we see is the NASDAQ is currently at a structural support level. It tested a lower structural support level just here at 13,364, and it's coming down through that fresh air gap into a safety net of buyers. What we want to see now, if the bulls get their way, will actually push up to this 13,587 mark. this structural resistance level. If the bears get their hold, we would expect to come down to this 13,364 level. If the bears get a hold of the NASDAQ and push price down below this structural support level, we would expect prices to bottom out around 13,258, because there's some really strong structural support levels down here that would catch price. You're always looking for ceilings and safety nets inside market action. This is the way that you create certainty for yourself. You overcome uncertainty as well by knowing how different charts are important. When we look at the DXY, this is the US dollar currency index. The DXY is incredibly important. When the DXY comes up, typically stock markets, commodities and crypto come down. This is the general way of the DXY, but not always. Don't get sucked into simplistic rules. The one thing that we can see, the DXY has been rallying up. But where are the structural levels? We can see one at 106.7227. The DXY rallied up from a lower structural support level up to that structural resistance, and it has failed. This means that the DXY most probably is on the way down to the lower structural support level at that 106.4330 mark. And if it doesn't go there, it will seek to come up and retest. All support and resistance lines are dynamic by nature. A support line or a resistance line can flip the other way, so always bear this in mind. But this is how we deal with uncertainty. We observe price action in its natural environment and move with the flow of the market. Bitcoin and crypto are really fantastic indicators of risk-on or risk-off activity. Let's just pop on the indicator. We can see a variety of different structural supports underneath Bitcoin's price, and we can see higher levels of structural resistance. I want to show you how this plays out in practicality. When there are too many structural resistance levels inside the market, what happens is the sellers step in here and push price down. A lot of people would look at Bitcoin just going up and saying, oh, Bitcoin's just rallying. It's going to put it in a God candle, which is a really big candle, and it's going to go up forever. No, it's just going to hit an SL, a structural resistance level. And when it hits a structural level, it's going to rebound from it. Like we saw with structural support, it gravitates around these levels. Structural resistance, it's pushed down from these levels. If you know how the structural levels are playing out, you're not ever confused about what price is actually doing, and you wouldn't be surprised at all with this result. One very powerful way to get around uncertainty and to create more certainty, please make sure that you look at the structural indicator first before placing a trade or investment. You don't want to buy at resistance and you don't want to sell at support. You can see why it's vital to know where the structural levels are on your Tier 1 charts, especially your Tier 2 and Tier 3 charts. When you look across the different structural levels, you can stack probabilities. If you would like the indicators that I use on the daily channel, you can just pop across to ctksmethod.org. You can also learn how to do it yourself there or inside the masterclass. It's a skill that you learn once and you can apply for a lifetime. We have an incredible global family, and I would just like to share my appreciation and gratitude for you being here. Inside financial markets, we create certainty through our knowledge and stacking of probabilities and understanding of structural levels. When you have the knowledge, you don't get upset by anything that happens inside the market. You just create a new rule from it. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.